Hello, how are you? It's Ibsen here, Ibsen Alexander. I'm going to talk to you briefly today about net present value, NPV, and internal rate of return, IRR. If you want to take a look at more of the information in terms of articles and Excel sheets that I have, you can go ahead and take a look at them at refivest.com, refivest.com. That's REFIVEST.com. But anywho, it seems to me that NPV and IRR, it's not, especially IRR, it's not that complex because IRR still has some of its limitation as well. But let, let me talk briefly about them. Okay, so NPV and IRR are just two basic metrics of a feasibility analysis. Okay, think of it this way, and they are not that difficult to understand if you break them down into very logical steps. So when you think about the net present value, the NPV is really defined. What exactly it is? It's just the present values of all individual cash flows. Okay, that you have, both incoming and outgoing as well, of a series of cash flows. That's all it is. And then so we can go ahead and ask, what exactly is the present value then? Well, if it's the sum, okay, if it's the sum of present values of individual cash flows, then we need to know what exactly those present values are and what the present value is defined as, which is the current worth of a future sum of money or stream of cash flows at a certain discount rate. That's all the present value really is. It's just the current worth of a future sum of money, future sum of cash, or stream of cash flows at a certain discount rate. Say that discount rate is 10%, 5%, 8%, and so forth. Well, then you may go ahead and ask, what is the discount rate then? Discount rate, think of it this way, it could so that discount rate, let's say that 10% or 5%, okay, it's just a rate that we take that cash that we put in and discount it for the future cash flows to find that present value. So it can be, for example, your cost of capital, it could be your cost of equity, cost of debt, things like that, desired rate of return. It could be your hurdle rate. It can even be the risk-free rate in terms of interest rate that your central bank or bank charges, and so forth. So now I will not touch on IRR right now, but I will leave that for a later video. What you will see, I will try to demonstrate on a blank sheet of paper some of the computation, very easy computation and so forth. Then I will proceed in an Excel sheet and do that again as well, so you can see, right? But let's put it this way. For some reason, you let's say you have your friend or your father, your mother, whatever, your boss, give you $100 tips or $100 bonus. Let's say it's 100,000 if you're at a job board. $100. Let's keep it simple. Okay, so that, say you take that $100. Okay, the $100 you have, they give you $100. Okay, you take that $100 and you go ahead, you deposit it at the bank, right? So that's the amount that you have, and the interest rate I was talking about, let's say it's 5%. So you have $100 and the interest rate is 5%. So when we think in terms of cash flows, so what we have here is, let's say you have year 0, you have year 1, correct? And what happened is that you went ahead and you deposited, you go into a bank, you deposit that, you deposit $100. You deposit the $100, that's for year 0. And year 1, you did not deposit anything, so you have $0 in there. Okay, not correct so far, except the fact that this $100, because now it's out. Think of it that way. It's been it's not credited. From an accounting perspective, it's debited. It's, you had $100 out of your pocket, you put your hands in your pocket, you take that $100 out, and you deposit in the bank. It's gone. So that's negative. You don't have that anymore, correct? So interest, let's say interest payouts, okay, what the bank's paying you first year of it's year zero, so there's no interest, right? And what happened is that in year five, in first year, you get $5 interest on that $100. So what happened then? You have your principal, okay? Ooh, that's a very bad P. Wow, very bad P. Anywho, you have your principal, nothing here, and you have $100 as your principal. That's year one. So now we can say that your total cash flow, okay, your total cash flow at this point is minus 100 and $105, $105, right? So that's pretty much the computation. What all this is, what you're looking at, all it's saying is you go ahead into the bank, you deposit $100, and after 1 year you got $105. That's all there is to it. That's really all it means, because that's what you get at interest. So it means that that $105 that you're looking at here next year is worth $100 today. Okay, so that 105 is really worth $100 today, which is year zero today. Because if you take that $100 and you put it, you go into an interest bearing account like a bank, which doesn't really charge, well, doesn't give you any interest. And think of next week or a year from now, okay? By next year, that's what it's gonna worth. It's not gonna worth the same because of inflation. Okay, so all that, this is just a concept of present value. If you truly think about it, that's just a concept. All you're doing is just saying calculating the present value means you finding the worth of future cash flows as of today. Okay, again, you're finding the worth of future cash flows of what is worth today. So you're finding the worth of this future cash flow in terms of what is worth today. That's just the concept behind it. And the interest rate, that 5% interest rate there can be referred to as discount rate. In the present value calculation, you'll see that later. Okay, and now, so what is the net present value? The net present value is the sum of present value less the initial outlay. Okay, that's what the net present value is. So in a sense, let's say you take that $100 and you go ahead and you deposit that. You deposit in another bank that charges you 5% interest. But now, in terms of, besides having just year zero and year one, you have 5 years. Okay, you have 5 years, and what you're going to find out is that there will be usual interest payout. So what will be the present value then? And what will be the net present value? Will it be the same? Of course not. Of course not, because now you have 5 years, right? So to make this simple, let's take a look at it and see the difference. Now you had, I'm going to write this very small, see if I can get it correctly. You had the amount that was invested, okay, $100, and your interest rate, remember, was 5%. Interest is 5%. So now if we think about cash, let's take the cash flows, and say now you have year 0, I'm just going to keep it as Y, year 1, year 2, year 3, year 4, year 5, right? So you go ahead and you deposit. Remember, it was $100. Okay, that's $100, and so there's nothing here, because keep in mind that once you deposit that money, you can't you deposit it, you're depositing the $100 in just one time, not 5 times. Okay, now what you have for your interest payout, you have 0 here. Remember, it's interest every year. You get some interest. They pay you some interest. The bank pay you some interest. That's too generous for a bank, but this is for just for example purposes. You will not get 5% on interest. So what happened is becomes, this is dollars. So you get $5 in return for interest payout, because you keep the money in the bank somewhere. Okay, now your principal, okay, is $100 at the end. That's what you put in, remember? Now you have your total cash flows. Okay, we can say that your total cash flows, this is negative, of course, it's negative 100. 0 plus 5, this is $5, this is $5, this is $5, this is $5, this is $105. I know it resembles a 3, correct? It's 5. Okay, now I said I wasn't going to talk about IRR. Let's understand this for a little bit. Let's just understand IRR a little bit. Assume that you have a condo project or a residential building project that cost about $100 million, but for example purposes we'll use $100 instead of $100 million. So the project now is going to be constructed within a year, and from there on, what's going to happen is that the next following year, we're going to receive that rental income of $7, which is about, let's say it's $70,000 or $7,000. Okay. What we will do next, we will go ahead and sell the building at the end of year 5 for about $130 million. Okay, so I'll repeat that again. Let's say that to understand the internal rate of return now, I know I said I wasn't going to talk much about it, but to understand that, let's say we're assuming that the residential building, okay, project cost about $100. You go ahead and you purchase that, you acquire the property. It's $100 million, but for price, for example's sake, we'll just keep it at $100. The project is constructed in a year, and then from there on, what's happening the next year, we are receiving rental income, and we have a couple of retail tenants there. We have other tenants who are helping with the rents for cash flow from the leases, and we're getting $7,000. We'll keep that at $7 for example's sake. Now we'll go ahead and sell the building in year 5 for $130,000. What is the internal rate of return? What is the IRR? Okay, so what I'm going to do, I'm going to pause this video right now and let you reflect on it a little bit, and I'm going to come back next in another video and show you the following example I'm talking about in terms of the IRR, and after that I'll have some example of the Excel videos that you can take a look at as well. Thank you, and see you in the next video.